Today's interview is with Travis Watts, aka Caution. You'll see when you listen to the interview why I say that. Really fun interview today. Travis talks about how he went from working in the oil industry to being to working on Wall Street for a brokerage firm, to then working as investor relations for an apartment syndication company called Ashcroft, to also investing all his money in passive investments. So really fun interview today. As always, like and subscribe on Wrestling with Real Estate, the YouTube channel. Go to the WWRE Podcast and give me a 5-star rating and write me a review if you think it's worthy. And I'm hoping to speak to as many of you as possible. If you're interested in real estate and you think there's any way I can help you, I'd love to set up a 30-minute call and we can get on there. You can ask me as many questions as you can, and hopefully I'll be able to help you and get you the resources that you need. So go to the link in the description below and sign up for a call, or go to the wrestlingwithrealestate.com website. And there's a link there you can sign up as well. But before that, enjoy today's great interview with Caution. Hello and welcome to Wrestling with Real Estate, where we look to choke slam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multifamily real estate investor, Barri Griffiths. Now today we're joined by Travis Watts. What's up, Travis?
Barry, I'm so thrilled to be here. Super excited. Thanks so much for having me.
No, the pleasure is all mine. Thank you for being here. I really appreciate you making the time. I'm glad that we were able to connect. Before we jump into the conversation today and have a lot of fun, I'm sure we will, do you want to tell us a little bit about your background and kind of where you are now with things and what's going on with you?
Sure, happy to. In fact, so I mentioned before this that I had a surprise to share. I didn't tell you what it was, but this is the perfect point to start the journey, so to speak. So what I'm going to do, and by the way, let me just say this. I've done, I don't even know how many, 60, 70 podcast interviews. I have never shared this information with anybody. In fact, most of my family doesn't even know this. So with that, without further ado, you may or may not have heard of this particular wrestler, but I want to pull this up on the screen here. So ready? Boom.
Whoa,
that
wow.
Right there is where it all begins. That's this guy right here as a wrestler back in the day.
That is phenomenal. Wow, that is so cool. So for anyone in the podcast, what are we looking at now for people who can't see what we're looking at?
Yeah. So this is my cousin and I. This is my cousin Dustin and I as kids. We had this trampoline and a whole bunch of props. We were so inspired by wrestling. We went through that phase for numerous years. And so we'd go and we'd buy the belts and the gloves and all these things. And then we had a video camera, and then we would just do the backyard wrestling stuff, you know, jumping off the porch to the trampoline and slamming chairs over each other's heads. It was great fun. So this is a picture of me, my cousin. I'm up on a ladder. I got these goofy looking moccasins. I don't know what that's all about. I got this fake microphone up here, and I got these, I don't know, like NWA, I can't read them, some kind of wrestling association gloves. I don't know. And that's us, man. That's really cool. This was our weekend fun. So I was a wrestler too.
You're the first, I was going to say, you're the first wrestler I've interviewed on this show.
I knew we had some kind of connection, and I finally figured it out.
And you were the champ as well. I'm impressed. I didn't know should I refer to you as Travis or champ? What should I refer to you as?
Yeah. So, and it's funny because I think, but I'm not confident, but I think my wrestling name was Caution. And the only thing that triggered that was there's caution tape on the ground. And we used to fake well, not fake, we'd actually do our entrances. And so I would rip through the caution tape and then jump off the porch. Oh man, that's some good
awesome. Stuff. I love that. And I love that your cousin has a stash as well as a mustache.
Oh yeah. He's like 13 years old. He's got the full blown mustache and the elbow pads. Oh man. All right, I'm gonna take that off the screen.
Phil, thanks for sharing that, man, and having a bit of fun. That's awesome. I was not expecting that at all. I had no idea that was coming. That's really cool.
That's why I was so excited when you reached out and said I'd love to have you on the show. I thought, yes, I know what I'm gonna share. All right, cool. So
Yeah.
enough of that. So that's where it started, right? And then, then I got into real estate. So basically the story goes, a long time back. So I was in high school and I was visiting with my dad. My dad's a very frugal guy. He goes to garage sales and thrift stores and things. And he came home one day with a book, and it was Rich Dad Prophecy. So a lot of people talk about Rich Dad, Poor Dad, Robert Kiyosaki's big famous, debut book. This was Rich Dad Prophecy, written several years after that. And it was my first eye-opening look into the world of investing and real estate and the stock market, and starting to pay attention to what all that is and how all that works. And, I was not anywhere ready to start investing in high school, but I was just drawn to it. I was just genuinely interested in the subject. And of course, anyone who's read Robert Kiyosaki, it's very philosophical, it's very high level, but it really is inspiring. It's uplifting, that just the way of his writing. So that was my first, seed, so to speak. I put that in my mind, moved on with my life, went through college, did all kinds of other things. And then in 2009, as housing had basically collapsed in most markets, this is like right after post-college for me. And I was moving back to Colorado, and I had to make a decision. Was I going to rent or was I going to own? And that was a big decision to make. And at the time, the government was handing out a $8,000 first-time homebuyer tax credit, much like what's being proposed right now with the Biden plan, which is now a $15,000 first-time homebuyer credit. And so I just took the chance. I took a leap of faith, and I said, this real estate thing sounds interesting. There's a lot I could do with it to be creative. I could house hack, rent a spare bedroom. I could make it a rental property later. I could do all kinds of things. So I took that leap of faith in 2009. That was my first property that I purchased, 2-bed, 1-bath, $95,000 place out in Colorado. And I did end up renting the spare bedroom out. And that was my first seed to passive income. Because now I had this college student who, I just graduated college, so I knew the game. I knew people needed a place to rent, so I bought a place next to a college campus. And so, here's this guy handing me a check for $600, and my mortgage payment was $640. So I thought, wow, isn't that interesting? I am basically living for free right out of the gate. And that really got the wheels turning. What if I could do this 10 more times? How could I scale this out? How could I get passive income rolling in? And from there, long story short, I'm going to summarize my story so I'm not too long-winded, but I knew I needed a higher paying job than what I had. I wasn't earning very much money at all. It's like 25 grand a year or something. And I thought, man, if I'm going to get serious about real estate, that's not going to cut it. So I joined the oil industry. That was in my area, kind of the highest and best paying gig I could get without any experience or background. And so I went working, believe it or not, looking at this guy, the oil rigs, and I did all kinds of things, worked for a big oil service company, moved around, worked overseas in Saudi Arabia, ended up getting into like health, safety, environmental stuff, and helped launch a safety program in Saudi Arabia and in Kuwait. And, long story short, what was happening is as I was doing that career, which I didn't like, by the way, I only did it because of the pay. And so I could take that pay and put it into real estate. So I was trying to scale the only way I knew how. And that was without a coach, without a mentor, without a lot of books, without a lot of podcasts like this. And, I didn't know what I didn't know. And here I am trying to, gain more and more single family homes. It's getting harder and harder and harder because there's all kinds of management and turnover and leases and move-ins and move-outs and property managers to deal with. And I got overwhelmed. I was working 100 hours a week. I was trying to do that on the side. So you can imagine, right? That's an inevitable burnout. At least for me it was. And so by 2015, I was about 6 years in, I was completely capped out. I mean, I naively years ago, I had said, hey, I'd love to have like 100 single family homes one day. I wasn't even 20% of the way there, and I was maxed out. And I thought, there's no way, man, I can't scale to that. And so I had to learn. I had to actually go back to the drawing board and learn from other people, find mentors, find coaches, listen to books, podcasts, all this, to learn how to be a passive investor. How could I still stay in real estate as an asset, for the tax advantages and the leverage and the cash flow and the passive income, but without having to manage the properties, without having to manage the tenants, this kind of stuff. And so that's really kind of how the story goes. I discovered multifamily apartment syndications or private placements. And that was really, to me, that was the light bulb moment that happened in 2015. And this is what I had to study, is how are people like Robert Kiyosaki, I already mentioned him, how is he investing in real estate? Obviously, he's not buying single family homes and self-managing them or having a property manager. So he's buying apartments. He's an LP, he's a JV, he's doing all kinds of things, and some are individual purchases. But I really wanted to get into multifamily space, and that allowed me to then step away from a career I didn't like, which is the oil industry, and start pursuing things that I genuinely had an interest in. I went to go work for a brokerage firm. I learned stocks, bonds, mutual funds. I wanted to know Wall Street and how that system worked and how that stacked up against real estate, so that I would have more of a unbiased opinion when I talk about this stuff to family, friends, and whoever. And, I fell out of love with that pretty quickly. And, I moved back to real estate. So I'm a full-time limited partner, full-time passive investor. And what I really advocate to others is this idea of, or the strategy rather, of acquiring multiple passive income streams to help offset your living expenses. And when you cross that threshold, when you have more passive income than you have expenses, you're financially free, financially independent. You can retire, whatever you want to call it, right? You have freedom over your time. And so that's really what my message is, and kind of some elements there to my backstory.
Yeah, very cool, very interesting story. Very unique story to go to those different places. Going back to that Rich Dad Poor Dad, to the Robert Kiyosaki book, Prophecy. What is that book about? I've never read that book, and very rarely heard it mentioned, actually.
It's probably one of the most unpopular books that he's written, as far as how many people have read it or talk about it. Rich Dad Prophecy is about Robert Kiyosaki's, rich dad, which was really his friend's dad, that basically was foreseeing a huge economic meltdown somewhere after the year 2000, and then, through like 2016. It was somewhere in that range. And so I was reading that, coming up to what we now know as the Great Recession. So whether or not he was coining the Great Recession as that moment, or whether it's something in the future, or whether it was the dot-com bust, I don't know. But, again, Kiyosaki's very high level. And it was just this idea that if you're going to be in the stock market, you're going to get hosed. If I could sum up that book in one sentence, that's it. And so it scared me to death, not knowing anything about investing. But anytime someone would say stocks, I'd go, no. I can't, I don't want to do that. And, to his credit, I guess, I stayed out of stocks. I did have some leading up to entering college. I went into cash. I don't know, dumb luck. Maybe it was the book. I'm not sure. But, it avoided the first kind of hurdle there. Not that we're not going to have another and another and another, but I avoided the first one, right? And that got me pretty interested, of course, right? That I thought, hey, can you predict these things, or this is interesting, should I never be in stock? So that's kind of just what got the wheels turning, like I said, for the journey. But that's what the book's about, is kind of anti-stock market and be prepared for an economic meltdown, so to speak. Interesting. And now that we're on the subject, not to jump all over the place, talk a little bit about when you went to work for that brokerage, right? To learn stocks, bonds, and mutual funds, so that you could see how it fed up against real estate. What did you learn, and what did you how do you feel about it now? Because, ultimately there is no wrong investment, right? You can be successful in stocks, you can be successful in real estate, you can be successful in Bitcoin, you can be an entrepreneur. There's tons of stuff you can do. There's people successful in all. So there's no right answer per se, but what did you feel and what did you see during that time? Yeah, that's a great question. The primary purpose, as I alluded to earlier, was to have more of a full-blown perspective on investing, right? I didn't just want to be the one-trick pony and know one thing and one thing only. So basically, what I learned was, in Wall Street, the whole name of the game is assets under management, right? It's getting as much capital in under the management roof of the brokerage or in the 401k or what have you, and then charging a fee. You know, here's a fee because you have an account with us, kind of thing. So there wasn't a lot of alignment of interest, right? So as an investor, if my account went up 10% this year, let's say that they would pull a 2% fee, whether that was through the mutual funds or through the account or through the management or whatever. Well, equally so, if my account was down 10% this year, they still pulled their fee. You know, so I just don't like that strategy personally, or I shouldn't call that a strategy. I don't like that, methodology or philosophy, whatever you want to call it. And so that was the biggest lesson learned, I think, was there's not a lot of alignment of interest. And, you know, this brokerage was saying, hey, here's basically, again, I'm summarizing to make this story a little simpler, but here's 5 mutual funds that we have, you know, let's just say these 5 are theoretically, you know, right for everybody because they're diversified. You know, if you're old, this one, if you're young, that one, you know, whatever, conservative, aggressive. Well, it was too simple, you know, and it's still, all of them went down when the market went down, you know what I mean? So there just wasn't a lot of education provided to the employees in that industry. That was really what my experience was. And I was working with a lot of students that had just graduated with their financial degrees and things. I don't know how I got that job, by the way. What made me so qualified? I own some rental properties. I don't know. I kind of lucked out, I guess. But it was a great learning curve. It was a great education. I'm not here to bash Wall Street or the stocks, bonds, and mutual funds. Could be appropriate in allocations of your overall portfolio. As you said earlier, some people are, man, they make millions and millions as day traders or options traders or just in the stock market in general. For me personally, every time I've really invested in stocks short or long term, I've lost money. I'm not good at it. It's just not my thing, you know, and in real estate, it tends to be pretty much the opposite side of that coin. So I went with what worked and I doubled down on it and I left that industry so I could pursue real estate more seriously as an actual professional and not just as a side hobby or, yeah, you know, I have a couple rentals or something. I really wanted to be a real estate, you know, professional, quote unquote. So those were some of the lessons learned.
Yeah, that's interesting. And from what you learned, you know, let's kind of compare from what you talked about there, an apartment syndication, because if we compare real estate, that's an unfair comparison, right? Because you have, you know, as you mentioned, Airbnb, flipping, wholesaling.
Oh yeah.
Bird dogging, apartments investing, self-storage, or you know, the list goes on and on and on and on and on. You have all this different kind of. But in terms of what that company you worked for was selling and how they were operating and the way things work, as opposed to apartment syndications and being a limited partner, an LP, and as a passive investor. What differences do you see? You know, we know which one we both favor. I think you know, I'm in the same boat as you. But how do they stack up against each other, and what differences are there, do you think?
Sure. The thing I like personally about private investing in a syndication or a private placement is, one, it's more personal to me. Like I'm finding a general partner that I like to work with, a sponsor. I'm having conversations with them. I'm getting to know them. And more importantly, we're usually co-invested in the same deal. In other words, you know, instead of my portfolio goes down and they collect a 2% fee, it's not like that. Their money goes down with the ship, number one. And in most cases, they're not going to be able to collect a fee when we're in a negative territory situation, right? So it's just got more of an alignment of interest. Obviously, every deal is different. Every syndicator is different. I'm speaking broadly across the board, not representing any particular company. And for me, I can't stomach the ups and downs of the stock market. You know, someone comes on TV and says the sky's falling and all of a sudden I lose 10%. How does that make any sense, right? That even being invested in real estate, but publicly traded like a REIT, a real estate investment trust, you know, they're always up and down, up 5%, down 5%, but what's changing day to day? Nothing. You know, the collections come in, the renters are still there. I just don't like volatility. So not to say there never will be or never is volatility in the private space. We both know that wouldn't be true, but it's far less and it's far more just, it's slow moving. You know, the things that we saw back in March 2020, This year, when the market just dropped 30%, nearly overnight, in a matter of days, whatever, that doesn't happen in the private real estate space, right? Wake up tomorrow and your apartment communities are 30% down. It's just not reality. So those are some of the things that I like about the LP route. Getting to work with people I like individually. Good luck getting on the phone with CEOs of companies and publicly traded and asking them how things are going or whatever. So yeah, that's a little bit of my take on it.
Yeah, that's interesting. Yeah, I agree. I have CNBC on here and there, just kind of seeing what's going on with the market and kind of getting a feel for the economy a little bit and things like that. But sure. It's just crazy to me. Like today we're at November 9th, Monday, November 9th, and stocks are up today, I think, at an all-time high, right? If you take the Dow Industrial Index, right, it's at a crazy all-time high. And I know it's on the route, but it's, what's the saying? Buy the rumor, sell the fact, right? And it's just, I'm like you. I couldn't, even in the worst of times, it still kind of went up, right? A million people are claimed unemployment this week. Stocks go up, right? It's just insanity. It doesn't make any sense whatsoever. And I know people are going to say, well, you just don't understand it. And that could be true. And that's probably the reason why I don't like it. I don't understand it. That's why I like real estate. Simple. I buy a building, or I partner with someone that buys a building, they fill it up, or they have tenants in there, they have great tenants, they take care of those tenants, they take care of the property, everyone prospers and makes a return, right? It's easy to understand, whereas stocks, I don't get it.
There's so much involvement. And to your point, I'm not going to at all be political on this show, but here's what I am going to say factually is, over the weekend, this is again, November 9th on a Monday, we just learned that the president-elect is Joe Biden. So if you go look at the Biden tax plan, it's anti-stocks. I mean, really, right? It's raising corporate tax rates and it's taking away incentives and benefits and eliminating this, that, and the other, all for corporations. And yet here we are Monday with the stock market skyrocketing. How is that even feasible? Again, I don't get it. Maybe I'm going to go with, I'm not smart enough, but I'm also going to go with, I don't care because I don't invest in it. So, I think that the lesson learned is find what works for you, become a master at it, and do your best, simple as that.
Yeah, I'm just like you. I think you're smarter than me. I don't think I know you're smarter than me, but for sure I don't understand stocks. And like you, I don't think I necessarily want to understand, right? I think we found a niche that we like and real estate that we love, and that's, does what we need it to do. And I think, like you said, that you just double down on that, right? Find something that works. And if it is stocks for you, for anyone listening, I'm not knocking you. If you find stocks attractive and it works for you, double down on that, make that work for you. But whatever it is, just figure that out. I think that's important.
Absolutely. Yeah. One of my best friends, by the way, side note, is a day trader. He does swing trading and day trading. And that's his thing. He's been at it 5-6 years. He does things I could never even, think of doing. And that's great. And so we give each other crap, on both sides of the coin. He's always trying to take down the passive investing, and I'm always trying to take him down. It's all in fun. I don't really care, but that's the point, right? It's just not my study. So
yeah. Maybe I should have had him on, and you guys could have had a wrestling match to figure out which one's better.
We should. We're get a trampoline pulled out here, and I'll show him what's up.
So as as you're experienced as a passive investor, for people who don't fully understand how it works, maybe they've heard about it, or maybe they've never heard about it. Do you want to give us a quick breakdown of, in simple terms, what it is to be a passive investor and limited partner on some of these deals that you've done and been a part of?
Sure. Yeah. I'll kind of take it from two approaches. To me, and I'll share this first. I was listening to, we've been talking a lot about Robert Kiyosaki for whatever reason, but I'll mention this. I was listening to him here recently in 2020 speak live, and someone asked him something about real estate, like something, you're a big real estate guy. And he says, I'm not a big real estate guy. He said, yeah, I own a lot of real estate, but you got to look at why I own real estate. He said, it's about leverage, using other people's money and debt. It's about the tax advantages that I get. And it's about the ability to produce passive income or cash flow. That's it. He said, you take those metrics and put it on anything else in the world, I'm an investor in that now. Forget real estate, I'm moving there. And that's the whole point. behind all this stuff is that to me, to clarify, my message about being a passive investor is that it's something you don't have to trade your time for money. Okay, simple as that. So it doesn't have to mean real estate. It could mean bonds, annuities. It could mean CDs in the bank, like interest earning, loaning your money out as a debt lender, and getting interest back. It's just the idea that you're building multiple income streams you're not working for. Those are coming in without you having to do much of anything. And then it's building that in a diversified way to overtake your expenses, like we talked about earlier. So that's one way to look at it. Now, you also asked about the real estate side. So how it looks to be, or what it means to be a limited partner is when you have a syndication or a real estate private placement, generally speaking, I'm going to have to generalize this topic. You have general partners or sponsors of the team. Those are the people who are active. These are the people that are trading their time for money, rightfully so. They're good at what they do, hopefully. They're best in business, hopefully. And so they're out there building connections with brokers and realtors. They're finding deals off market. They're walking units. They're putting together with attorneys, the legal docs and the presentations and the slide decks to show potential investors. And they're managing the asset. They're essentially like an asset manager. They may not be the property manager in some cases, but they're managing the business plan, okay? So that's the active side of the business. Now, as a limited partner, what I do, I'm the passive investor. So I'm on the other side of the coin where I'm saying, hey, Jill and Joe, the general partner, here's $100,000. I would like to invest in that apartment complex that you're putting together out in Dallas, Texas. And I'd like to share with you in those potential profits, either cash flow and or equity. And so, what my active role is vetting out Jill and Joe, vetting out that market, vetting out that deal and making a decision. Yeah, I want to take part in that. That sounds like a good deal. I'd like to be part of that. And then from there, when I'm wiring funds or sending a check, it's usually completely hands off for 3 years, 5 years, 7 years, 10 years. It depends on what the business plan is, right? And that's always a projection. That's always a kind of a moving target. We never really know. So at the end of the day, I'm trading control, decision-making, in exchange for diversification. I get to invest with Jill and John and Joe and Schmo and everybody else nationwide, all different sponsors, all different geographies, all different asset classes. It's to me, it's a thrill. It's a lot of fun. But yeah, that's kind of what it is. So I launched a show, by the way, with Theo Hicks under the Best Ever brand called the Actively Passive Show. And it's the irony that I'm a passive investor, but there's active components. You do have to watch CNBC, like you pointed out. You do have to pay attention to the Biden versus Trump tax plan. You have to know what's going on so that you can make the best decisions. And you have to know from a high level how to vet teams, markets, and deals. It gets easier and easier the more you do. And then from there, it's mostly passive. And so, yeah, hopefully that helps define for people listening what it is.
Absolutely. Yeah. Because I think, not everyone, some people that are just maybe tuning in and just have some interest in real estate might not understand how it works. But I think a lot of people as well think it's somewhat of a scam sometimes because it's so good, right? You invest your money and you can be involved in a large, let's take an apartment syndication, for example. There's syndications in different models, but in a large apartment complex, you can get a good return, say a 7 or 8% preferred return, which means you get your return before any other general partners get a penny of theirs. So there's an alignment of interest. And you get to be part of this great piece of real estate that you could never probably afford yourself. And again, you get that cash flow, you get the appreciation or whatever appreciation that property gets, and you get the tax benefits, you enjoy the debt pay down as well, because that part of that property is yours. All these things, all the while by not having to be at the property, having to talk to contractors, having to talk to brokers, having to talk to property managers, having to talk to tenants, having to do all that work. you get to sit back and just enjoy that. Right now, it's not quite as simplistic as that, as you touched on. There's some vetting that you need to do up front, but it really is a phenomenal type of investing.
Yeah, that's just it. Is, back in 2009, had you asked me something about, being an apartment investor or who's buying these 400 unit apartment complexes, I was so naive. I probably would have said, well, it's either billionaires or it's people that have like 30, 40 years experience in real estate, but that's just simply not true. And exactly to your point, what am I in reality on one of these projects when I'm a limited partner? I'm like a 1% owner of like a 400 unit apartment building, 1% of cash flow, 1% of equity. It just kind of depends on the model, but that's what it is. So I had no clue that a lot of these properties are bought that way. I either thought it was institutional capital or highly wealthy and or experienced individuals. So gosh, so many people, wrestlers, pro athletes, right? Doctor, dentist, lawyer, attorney, so many busy working professionals, highly paid professions. These folks looking for a place to put capital, and maybe they don't want to put 100% into their 401k or their IRA or just the stock market in general. It could be a diversification strategy. So, but to your point, you mentioned, it sounds like a scam to some. Yeah, that was me. When the first time I heard syndication, I'm looking at a deal pro forma, I'm thinking, yeah, right, this is ridiculous. I knew what returns I made doing active real estate, vacation rentals, flips, what have you. And I'm looking at basically those same numbers and they're telling me I don't have to do any work. Yeah, I was totally skeptical, but I did take a foot forward, and then one led to two and two led to three and 30, whatever I've done. It's been a fun journey.
Yeah, and what's cool as well also about syndications is a lot of times when you're working with people like, you work with Ashcroft Capital and I believe you've invested with them, they're very experienced and very knowledgeable and very successful in that field. So you get to ride on the, piggyback on their success and their skills and their experience and everything that they've done, the hard work that they've done over the years to build that credibility, to build those broker relationships, to be known in that market, to do all those things. You get to piggyback on that. You don't have to create that credibility yourself. You get to be part of their credibility, be part of their team by being a limited partner. And I think sometimes that gets missed, because if you were to start out as an active investor, you wouldn't be able to find the deals that they do. You wouldn't be able to operate properties the way that they do. You wouldn't be able to, do all the things that they do, because it took them years to get there, right? They didn't just start yesterday and get to this point.
There were a couple, that's a great point, Barry. And there were a couple instances I'll share with you, a couple stories that really got me to self-reflect, right? Because I was jumping headfirst into the active real estate, single family. I don't need a book. I don't need a podcast. I don't need a mentor. I know what I'm doing, right? Just kind of ego driven. And a couple things. One was a fix and flip. I think it was my second one that I was doing. I pulled in my mom. I guess she was in town at that time, and she's helping me paint or do something, hang something upstairs. And she yells down, can you bring up the, what does she say? The electric screwdriver or whatever. And I thought, I don't even own one. I'm thinking, wait a second, I'm doing a fix and flip. I don't even own an electric drill. Should I be doing this? Is this really my thing? Am I really that handy? And the fact I'm not handy at all. I can hardly paint. And so, and having to outsource everything and having to find a contractor to do everything. And, I'm shrinking profit margins, you know what I mean? And to back up to just buying that asset, I wasn't going about it the right way. I bought some foreclosures and REOs and stuff, but I was also just using realtors and bought a few properties just off the MLS. And quite frankly, I was just an amateur. And if I really was real with myself, which I eventually got there, I'm looking around at other people doing these flips in these same markets. And I'm realizing, to your point, they're the experts. They're the ones, they're finding deals way better than me. They're buying crap that's 40% off from what I'm buying it for. And they are contractors, and and so that's just it. When you realize there's people that are the best in class, they are the best in business, why not just share in the profits with them? They know what they're doing. They have a track record. They have a reputation. They have connections I'll never have, or it'll take me a long time to get them. So I would rather just share in that than try to beat everybody and think I'm going to be the best. But That's just me. And it took a while to learn that. So that's a great point though.
Yeah. Well, I think everyone can tell also that we're big fans of passive investing, you know, and the syndication model. I think it's really cool. So you're talking about the type of people that it might suit, but you know, what kind of people do you see that syndication and being a passive investor suits best? You know, because it might not be for everyone. And do you see a certain type of person that it works well for?
Yeah, you know, and I talked about this recently. It was on it was like a mastermind, I think that I was invited to, but I talked about the time value. You know, what is your time value? What do you value an hour's worth of labor for? And so the fact is, when you have a lot of, let's just use the typical doctor, dentist, lawyer, attorney example. So when you have these types of people working in a profession where they're billing out 200 an hour, 300 an hour, 400 an hour, does it make sense to go buy their own real estate, do all the work, you know, to potentially get maybe a higher return than what you might get in a syndication being a passive investor? Well, I've ran the numbers multiple ways. And what I typically come back with on a single family home, generally speaking, is about $50 an hour. So does it make sense then for a doctor to go to their office Monday through Friday, work their butt off, billing out 200, 300 an hour, and then take their whole weekend and go work for $50 an hour, trying to manage their own real estate from scratch, trying to read books, listen to podcasts, try to do all this stuff? In some cases, yes. In most cases, no. It's just not worth their time. So what I find as director of investor relations, as you mentioned with Ashcroft Capital, I talk to investors daily, weekly, monthly, all the time. I'm on the phone with investors, all different types, nationwide, all different professions. And what I find are there's a lot of people who are very much unlike me in that they love what they do. They're an engineer, they're a software developer, they're a business owner, they're an entrepreneur, they're this, that, and the other, they're a pro wrestler, whatever. I wish we had more pro wrestlers in our database. I can't say that's really true. Professional athlete, I can say that because we have a number of those. And, you know, again, they're looking for a place to park some capital. They're just looking to learn from a high level. What is this? How does it work? How do I go about vetting this stuff out? How do I know it's the real deal? And then when they're comfortable with a sponsorship group that has a proven track record, reputation, they've done this over and over and over and over and over, and they can show the results. Generally speaking, these are the folks that are just, you know, here's 50K for that project. Here's 200K for that project, you know, that kind of stuff. As a means of diversifying, and for some people, as a means to, you know, getting the retirement built up, so to speak, earlier on, right? Starting the cash flow journey in their 40s and 50s so that when they're 60, you know, they can pull the trigger and go retire. So I think the sooner the better. Here's another interesting perspective. We all have to get to a point, if we're going to retire ever, we have to become passive, don't we? I mean, we're eventually going to be on like a Social Security or having, you know, maybe a pension, you know, for the older demographic, or our 401ks, we're going to be selling out of those to live on. We're not going to be swinging sledgehammers and into our 80s, flipping houses. So we have to find a way to get there. Why not educate yourself now on this passive income journey so that you can have it now if you want it, or you just know what you're doing when you get to your 70s and your 80s. And now you're a very seasoned, experienced investor at that point. Some of the toughest conversations I have are speaking with someone who's, let's say, 70 years old and calls me to say, what is a syndication? How does that work? Is this something I should be interested in? And it's just like, it's not too late, but it's much harder, you know, to hit the learning curve at that age point. And so I just advocate, I do a lot of millennial education and things. I'm trying to plant seeds early on with people to think about, what if Social Security is not there for you? What if the 401k plan fails you? And we know there's not going to be a pension for most people. So we've got to start tuning in to taking a little ownership in our own investing and paying attention to what's going on.
Yeah, that's really interesting. Yeah. And you said that you speak with, you know, hundreds, if not thousands of investors across the board who are sort of have an interest in this. What are some common questions that people ask you when they're starting off?
Yeah, just a lot of questions surrounding those three categories of sponsorship teams. Who do you work with? Who should I pay attention to or not work with? Those kinds of questions. Markets, what markets are you investing in? Why those markets? And then deal specific questions. What do you think about cap rates in 2020? What do you think about COVID investing? What do you think about, and, generally speaking, again, I'm not an advisor or a financial planner. I'm pointing people into the direction of, here's a great article I read on that. Here's a great book that I read that can help. There's a great program on this. There's a webinar coming up on that. I'm trying to be just a resource for people. I'm not the know-it-all. I'm not the guru. I'm just the guy who's doing this full time, and I myself am doing all those things I'm recommending myself. But it's generally around those three categories, including what we already covered, which is what is a syndication or a private placement, just generally speaking, which I have PDF guides and all kinds of things I can share with your listeners or whoever on that in much more detail.
Okay, great. Yeah. So maybe touch on those three quick briefly. So what should people, when vetting a team, right? That should probably be people's, what should people be looking for when they vet a team?
Yeah, I think first and foremost, alignment of interest, alignment in philosophy. Okay, you mentioned earlier when you said, self-storage, mobile home parks, office retail, new development. There's a lot to choose from out there in the private placement space and the publicly traded markets. Education is number one. Okay, educate yourself on what the possibilities are, just from a high level. Okay, take a course, do some training, find a mentor, whatever. Then, when you're looking at a team, what I'm looking for, do I get along with these people? Do they pass my gut check? Do I have any, this person seems a little off or a little weird? I'm usually testing them on, I'll text them, I'll call them, I'll email them. This is all pre-investing to see what the response times are, and I'll even do occasionally, I know people probably hate this, I'll do a weekend, phone call. I'll just see, you don't have to pick up. I'm not judging you on that, but what if you do? What does that say about you? And by the way, that's something that Joe Fairless did for me before I started investing, is I called him on a Sunday at 10 in the morning just to ask a generic question. And he picks up, he's in the car, with his wife, they're going to church or whatever they're doing. And I'm like, hey, you didn't have to pick up. I was just going to leave you a message. And, oh no, what is it? How can I help? And I look for those types of relationships, in addition to what I talk about all the time, which is so important, is understanding what your criteria is. That can only come from a little self-education, whether it be a book, a podcast, what have you. But what I mean is, I like multifamily assets primarily. I like the B-class sector the most, 1980s, 1990s, early 2000 product. I like value add business plans with 5-year holds. I like monthly distributions. I like monthly reporting. There's a lot. This is all my criteria. This doesn't have to be right for anybody listening, but that's some things that I identified for myself, states that I like to be in, et cetera. And so I'm trying to find groups doing that. And that's the alignment, right? The last thing I want to do is be butting heads with someone for 5 years in an investment I can't get out of because it's illiquid. So that's a little bit about the team in General Partners.
That's a great, the last one, everything else it's all great, but the last one is something I haven't really thought about too much, because it's when you start out as an active investor, what do they always tell you? For people who don't know, they always tell you, find your criteria, right? Find your niche, find what is going to serve you best for what you're going to achieve, right? But it's no different in passive investing, because do you want your money back in 2 or 3 years, or are you happy having your money put there for 10 years? Do you want 200 unit plus apartment complexes, or are you happy with some smaller stuff? What serves you and why? And then go out and find a team that does that as well as the other things that you mentioned, right? Are they responsive? What is that gut check? How do you feel about them? What kind of track record they have? All that stuff, it all feeds in. And that's such a good point that I never thought about that before.
Yeah, no, that's, to me anyway, I'm only sharing my perspective on this stuff, but that's first and foremost when it comes to the team and the general partners.
So secondly, secondly, after the team?
Yeah. Secondly, again, my opinion is the market is second. And this was from a couple deals, hard lessons learned, where I wasn't working with a very great operator. They weren't exactly competent, but the market really saved us. We bought a good asset at a good price in a good location, you know, in an uptrending area. So here's the thing on markets. I look for tax-friendly states. I love Texas. I love Florida, things like that, just as examples. Landlord-tenant laws, that I like that to be in the favor of the landlord, so that you limit your risk of, you know, rent strikes and other things that can come up, the evictions, the whole deal there. We can't fully avoid that stuff, but we can place the cards in our favor, so to speak. I look at where companies are relocating to. You know, is Tesla going to leave California and go to Texas? If they do, what does that mean for jobs? Where are they going to relocate? You know, that kind of stuff, right? Because multifamily is all about your tenants having jobs that, you know, that they can get good pay from, you know, in a diversified job market. So again, we think about like Detroit in the Great Recession, primarily one industry there, right? The automobile manufacturing. So as that tanks, so do jobs, so do your rent collections, so did your property. So you want to find, you know, a little healthcare, a little oil and gas, you know, a little, you know, tech engineering, a little financial. So that's what I like, just to use one example of like Dallas, Fort Worth, very diversified as an overall job market, which is why I have a lot of properties there. Many other markets that way. So as an LP, as a passive investor, I do the macro level research. I look at where are people leaving right now, where are they migrating to. Got a lot of New York, New Jersey, and high tax states coming down to Florida. Got the California going to Texas. So I'm looking at the trends, and I'm kind of trying to predict, you know, educated guess on what might happen in 1, 2, 3, 4 years, at least the whole period of the project that I'm investing in. And then when it comes to the specific sub-market and the specific property, I can't be an expert. I can't know the answers. This is where I, you know, relinquish control and decision-making and expertise to the general partners, who will then say, you know, here's why Irving, Texas. Here's the stats, the facts. Here's the 3-mile radius around the property. You know, here's the exposure that we're going to have. You know, here's the track record, whatever. And so that's where it's a great partnership, right? I kind of know the macro level. They know the micro level. It's a good team alignment. So that's kind of how I approach. There's much more to it. Again, I have a PDF guide I'm happy to share with your listeners, but that's my general approach to vetting out a market.
Nice. And then lastly, you know, most people counterintuitively might think that the property would be first, right? Because that's what everything is based on. But yeah, I agree with you that, you know, the property is still important, of course, absolutely. But those two things are more important than the property, because if you don't get those first two things right, for the most part, if you have a great property, those two things are going to drag you down if they're not right. And the other way around, if you have an okay property and you have a great market and a great team, is probably going to ride you up a lot better as well. So maybe talk a little bit about the property, what people should be looking for, or what you look for, right? Because everyone's different. What you look for in the property.
Sure. Yeah. And just to relay on the point that you just made, that is kind of the theory anyway, is that with the right team, with a reputation, a track record, and experience in the right market at the right time, they're probably going to be finding a good deal. You know, they probably know what they're doing. So it's not to say don't look at the deal, of course. That is a very important component. But I used to have all that flip-flopped. And I started with the deal, and I was just crunching numbers, and I was just trying to find the deals with the highest returns and then parking money there. And then I realized how important a team is, because with an inexperienced team, they can't execute the business plan. And then all those projections you looked at go right out the window. They don't mean a thing. And so it's really, that's why I have that hierarchy that way. For the deal, again, get educated, podcast, book, mentor, what have you, doesn't matter. Find out some criteria metrics that you feel are most important. Some people look real heavily at cap rates. Other people look at conservative underwriting. What I mean by that is, let's say we're buying a property at a 5 cap rate. They're looking to see what is the exit projection cap rate, hopefully like 5.5, 6, you know, a higher number, which would indicate that we might be selling into a softer market, maybe a bad economy. But That being said, these are still the projections that we would get potentially if we did that. And that's really important to recognize, that you never want to sell at a higher cap rate. But if you did and you still got a decent return, well, that's pretty good. Because theoretically cap rates would go down, right? In a good uptrending market, and you're going to make even more than the projection. So you're looking for that classic under promise and over deliver situation. I look a lot at break-even occupancy. I'm just going to name a few here off the top of my head. That would mean, you got a 100-unit property, let's say, and the break-even occupancy is 65%. So you can lose 35% of your tenant base, or have 35% of people not paying rent for whatever reason, and you're still breaking even. You're not losing money. And that's really important. That's a hard lesson I learned too with single family. Is one tenant, right? You're either 100% occupied or 100% vacant. And when you're 100% vacant, you're negative right off the bat. You still got a mortgage to pay. You still got property taxes. You still got insurance. So it's worse. You go from making money to way in the hole. So anyway, I like the diversification of multifamily for that reason. I also look at debt. What kind of debt are they going to put on the property? Let's say it's going to be a 5-year hold business model, and we anticipate a sale in 5 years. Well, if that's the case, I like to see a debt term, the financing, with a 10-year term on it. Because what happens if we roll around in 5 years, anticipate selling, but now we're in the next Great Depression and the property value is tanked and things are underwater? Well, I don't want to take a loss. I don't want, and what if we can't refinance? What if lending dries up, and now we thought we'd just refinance and keep going. Well, you can't. So I don't want to be screwed basically. So that 10-year term gives us 5 more years to figure it out. We have a fixed rate term. If we can't sell in 5, let's hold it another year or 2 or 3 or 4 or 5. And yeah, those are a few metrics that I look at on the deals. There's many more, but everybody's different. So I don't know how much value it would be for me to go through 30 items, but yeah, just think about which items are most important to you on a property. Price per door is one more that I get all the time on calls. They're buying this so-and-so at $175 a door. Do you think that's too much? There's a lot more that goes into it than just price per door, but that is one metric to consider.
Yeah. All good stuff there. Yeah. Because, and that's why education is so important, right? You don't need to be the most educated person, but you need to understand what you're looking at and what these how these properties differentiate from each other, and which ones are a good deal perhaps and which one aren't. And it doesn't mean a lot of time studying. You don't need a college degree in real estate syndication, but you need to understand. And you can, over a few months, podcasts and books and webinars and things like that, you can kind of learn, and articles, you can learn all that you need to learn. But it's important to know what you're looking at, and the understanding of what makes a good property to you is important.
I do a lot of outreach on the education side too, just outside of Ashcroft Capital. And I can tell you, I get contacted by a lot of people who set up, Calendly appointments with me and want to chat real estate, who are in their learning curve from scratch. And I can tell you, on average, it takes about 3 to 6 months of dedicated education to be a successful LP investor. Some of that has to come from experience. You just have to get your hands dirty, so to speak. You got to do a few deals to learn some of it. But what I'm saying is reading a couple books, listening to numerous podcasts, reaching out to folks like me or anybody else out there in the industry doing this stuff, 3 to 6 months with dedicated focus is enough time, in my opinion, to be what I would deem a sophisticated investor. You understand the ins and the outs and the inner workings of this niche and how this stuff works, So to your point, no, it's not a doctorate degree. It's not years of study. It could be that. And for me, it's an ongoing study. Of course, I'm always trying to learn more, but I just mean to pull the trigger. When I first learned what a syndication was, to the point that I actually did a syndication deal, it was about in that same time frame. It was probably 6 months, give or take.
Yeah, very cool, very cool. Well, man, this has been fun. It's been a great conversation. You know, I love talking about apartment syndication and, you know, why it's a good fit for people as a limited partner, as a passive investor, because, you know, as you well know, it's not that this type of investing is not that well known out there, right? And I think the more we can shine a light on that and show people what's available and the options that they have outside of regular investing, right? As some people might call it, I think it's a great topic.
Absolutely. It's a shame that this is deemed an alternative investment. This should be perhaps a primary investment. At least in my world, you know, the stock market's an alternative investment to me, but yeah, great point.
Cool. Well, this show is called Wrestling with Real Estate, and I try and incorporate some wrestling themed real estate questions into the show. And the first one isn't necessarily a real estate question, but it's a fun one. Is what would your wrestling name be? If you had to pick a wrestling name for yourself, what would it be? And you might be good at this one.
As I mentioned at the beginning, I think my wrestler name was Caution, which is really goofy. I don't know. Probably just because we had a roll of caution tape in our house is why I picked that name. Could have been duct tape, you know. So probably wouldn't be much better.
I like Caution.
One of those two, I guess.
I like Caution. Caution is good. I like the sound of that. Every wrestler has a special move. What would your special move be in real estate? What is your strength in real estate?
Oh, man. You know, in all honesty, I wrote a blog not too long ago about kind of, you know, success and what that means in terms of, you know, the business world or investing. And willpower is huge. You know, it's self-discipline. I don't know which term I want to use to coin it. My signature move is willpower, because, you know, you got to push through. I mean, it takes dedicated focus. It takes self-discipline. A lot of my story, which we didn't really get into, is about personal finance. It's about how, you know, when my income shifted from what I mentioned, 25K a year to over 6 figures, I did not change my lifestyle. I didn't go out and buy the BMW and the Mercedes and the big house and I ate ramen noodles, and I didn't travel very much, and I didn't go out and party. I didn't go drink. I didn't do any of those things. And I didn't even upgrade my car. In fact, I downgraded my car, and I rented a spare bedroom in somebody's house temporarily. Like, it's that type of discipline, you know? And for my food budget, $2 a meal, 3 meals a day, $6 is what I had to spend on food, period. And I did that for a couple of years. And so I would say that would be the one thing that I would probably stand out in a unique way from a lot of others is the willpower that it takes to do that.
And the willingness to do what other people want, right? And I feel like a lot of times in real estate, because that's the field that, you know, we're both in, you meet these people all the time, right? The people that, like yourself, are willing to do what others are not, right? You're willing to eat ramen noodle, to downgrade your car, right? To do all these things, but there's a bigger goal in mind, right? You have a bigger picture. You know, you're not just living for now, you're living for the future. You're doing things, what is it saying? Live now, like, you know the saying?
Yeah. It's something like do what most people won't do for the next 10 years and live like most people can never live the rest of your life, or something like that, right? Put in the work now and benefit the rest of your life.
And it's so true, right? Because most people don't. They want that instant gratification and they can't see that bigger picture. So I hear it time and time again with people that they're willing to do what most people aren't. And I love that about you. I think that's really cool. The last question is, was there a moment that you were standing on the top rope getting ready to jump, but you were too scared? What was it, and how did you overcome it? And I don't think you were scared. I saw a picture of you on top of the ladder, so I don't think you'd be scared of the top rope.
We didn't even have any ropes, man. We had a wooden balcony. That was our rope. Yeah, gosh. I mean, you know, fear is a real thing for everybody, right? I mean, I listened to this, I don't know who was speaking recently, but they said courage is taking action in spite of fear. We all have the fear, you know, and I had it. Getting started was a really scary moment. I literally put about every single dollar I had in my entire net worth into that first property. That's a scary thing, because a lot of people say, oh, you got started in 2009. Lucky you. I remember asking friends and family, should I buy or rent? And the answer was rent. This is a horrible market. Things are falling apart. We just lost XYZ on our house. Don't buy property. I bought property. I went against the grain, and that was a scary thing to do, being so young and naive, but I overcame it, and so that was kind of the thing. And the next big thing I think I had to overcome was I decided in 2015, I'm selling it all. Everything I've been successful at so far, all these single family homes, including the house that I live in, I'm selling it all, and I'm starting over with this passive stuff. And I'm going to go a whole new path and a whole new strategy. And it may not have worked, so that was a very scary thing to do. So those were two kind of moments that I was up there having to overcome that hurdle.
And you did, right? But how did you overcome it? You just faced your fears, or what made you, with selling those properties, what gave you?
Yeah, I think in both cases, for me, with my mind, it had to be data driven. And so the one thing I knew about my house purchase in 2009 was this house previously sold for $165,000, and today it's on the market for $95,000, and the government's willing to give me $8,000 towards the purchase of it. That's all data. And that gave me enough certainty to say, yeah, worst case scenario, I'll get a roommate, they'll pay me some rent, and I'll cover my mortgage, and we'll see what happens. Maybe the house goes down to zero, but hey, I can cover the mortgage, right? I'm not going to screw myself. So the data helped there. In 2015, thinking about syndications, limited partnerships, private placements, I found a couple of people through a real estate group who were much older than me. I want to say late 60s maybe, who had been doing this LP investing for like 25, 30 years. And I got to sit down with them and I got to pick their brain on the subject. And they showed me some of their portfolio and how things performed. And again, that was data. And I read case studies and I looked at what happened to multifamily in the Great Recession. I obviously knew what happened to single family, generally speaking. And so all of that data gave me confidence and enough certainty to overcome the fear. So my whole thing is data driven. If I have enough case studies to support making a decision, that's what I'll do. I try not to ever just listen to one opinion from anybody, no matter what they're talking about. I try to go survey 10 people, and then I find the commonalities and I say, hey, all these 10 people here, they all own real estate. They're all successful. Maybe there's something to that. And that's where I move forward.
Yeah. There's definitely a lot of millionaires who've made that, a lot of, what is this thing? Most millionaires, 90% of millionaires have real estate in their portfolio, something along those lines, right?
Yeah, that's exactly true. Yeah.
Success leaves clues, right? There's a reason for that because real estate's a great investment. So cool.
Yeah.
Well, thank you so much, man, for making the time to be on here today. Hearing your story about how you started out reading the Rich Dad Prophecy and how that kind of started that ball rolling for you from being on the active side to working in Saudi Arabia for the oil company to then going into a brokerage. This is crazy, man. You such a random, completely different fields, and then now working as part of the investor relations for Ashcroft Capital. It's a fascinating path, and now also deciding to sell everything you have and then put it all into a passive investment is really cool story. And plus sharing with us, some things you see in terms of what a passive investment looks like, what kind of vetting you should do, and some stuff that we should all look out for. So phenomenal interview, man. Thank you so much for doing that and being here today. But before we go, how can people reach out to you and find out more about what you're up to?
Yeah, I've mentioned a couple times the PDF guide. It's called Understanding Real Estate Private Placements. It's a 20-page free PDF. There's no upsell course or book after it. It's just here's the info. It's industry terminology, how to vet deals, sponsors, and markets, questions to ask, ins and outs, definition, all kinds of good stuff. You can get that, or you can book a time for a Q&A call with me if you'd like. If there's anything I can add value to you, you can get it at the same place. It's ashcroftcapital.com/connect with Travis. You can either get the guide alone or do the call alone or get them both. Doesn't matter. Listen, I'm not here to sell anybody anything. I'm here to be a resource, to give back, to educate, and to explain what's really helped me and my family. And I'm just passionate about it. So definitely reach out if you have any questions about anything we talked about or want to go deeper, or want to know how something relates in your personal situation. Not a financial advisor, but I'll do my best to help point you in the right direction.
Cool. Well, thank you so much, man. Have a great day, and I'm so happy we were able to make this happen.
Thank you so much, Barry. I appreciate it as well.